The gentleman from Des Moines, Iowa, Mr. Nunn is recognized.
Mr. Chairman, very much a privilege. We are going to talk a little bit about Des Moines, Iowa today. As a freshman on this committee, in the last 3 months, we've seen 3 massive bank failures. Last week, I got to take my 16-year-old out to get a first car loan. The scariest thing about your 16-year-old driving shouldn't be the question of, is my bank going to be there next month as a result of what's been going on here? I want to highlight the fact that everyone has now concluded on this committee that it's not fair for my small mom and pop bank in a place like Creston, Iowa, which has 96% of its depositors insured, to pay for this risky lending behavior, particularly by banks like Silicon Valley Bank, where just over 1% were insured. So I want to begin, first of all, by applauding Chairman Gruenberg for heeding the advice of this bipartisan committee, as well as the work that you've done to ensure that small banks were not punished by the FDIC special assessment. Mr. Chair, I want to go a next level deeper here. Do you think that going forward, regular deposit insurance assessments should also factor in the unusually large levels of uninsured deposits? Why or why not?
I think the answer, frankly, is probably yes. It's one of the things we identify in our report on deposit insurance. One of the tools we have is risk-based pricing. And in light of this episode, we may want to consider increasing risk-based pricing based on levels of uninsured deposits. That's certainly something we have authority to do and something we can look at.
And I appreciate you looking at that. I'm going to take it to a next level then. Why should banks that are under more conservative management or higher FDIC, like my rural guys in Iowa, have to pay the same pro rata premium assessments that those banks that take on this greater risk?
They shouldn't, and we do have a risk-based pricing system. The challenge here is getting the risk-based pricing right, and for uninsured deposits, that may be a risk factor that we need to take better account of.
So is the FDIC prepared to take a more serious look at some of the risk-based calculations, and do you have a plan for how you're going to do that?
That was outlined in our report, and is something we are going to follow through on.
I'm heartened by that, and I thank you for taking a holistic approach to that. Vice Chair Barr, your fellow governor just last Friday, Mickey Bowman, gave a speech where she stated, "We should be careful and intentional about any significant changes to the regulatory framework, including imposing new requirements that will materially increase funding costs, like higher capital requirements." She's agreed with many of us here on this committee that the bank failures that we saw were the direct result of mismanagement and supervision, not the current capital regulatory requirements that some on the other side of the aisle may say. Do you agree or disagree with Governor Bowman on her assessment?
I agree that we should be careful and prudent in thinking about how to make capital changes. I do think it's appropriate for us to look at whether capital requirements for firms $100 billion and above are appropriate in the current circumstance. One area we're looking at in particular, for example, is whether we should use the rule that changes in the value of available for sale securities should be taken into account in the capital requirements. If we do make such a change, we would do that through a normal notice and comment rulemaking process with appropriate transitions. That's one example of what we're looking at.
And I respect that example. My concern here is that, in the words of John F. Kennedy, never let a good crisis go to waste. And I'm concerned that the Fed specifically is looking at exploiting what has happened over the course of the last 3 months with these 3 banks as an opportunity to really open up the regulatory channels and start governing by fiat in a way that really it should be in the role of Congress. Would you agree that you're going to be caging yourself after this series of committees on what I think is really some regulatory overreach, given that there are 3 very unique banks here and it does not reflect the larger financial sector?
Well, we'll be looking at capital in the system as a whole. I began a holistic review of our capital requirements in July when I arrived. I think that it would be prudent for me and for my fellow regulators to take into account what just happened to our banking system, rather than to shutter our eyes to that. So I do think it's important.
I appreciate that, but I think Governor Bowman said it very clearly here. You have the capability to go after these banks. When Silicon Valley Bank took out a massive level of risk, when they had the opportunity to have a risk officer who was asleep at the switch and not even existent for 8 months, we had a diversity of other positions included. you had the ability to go after SVB, and as even my colleagues on the Democratic side have highlighted, those safeguards were not protected. So I have a real concern when we think about exploiting a crisis to have more regulatory authority when you have those tools already in your toolkit. With that, I'll yield back.